Well, so there's the debt ceiling issue, then there's the recession issue. So let's watch this because this I got this. Where did I get this clip from? But they had some good takes. This also this CNBC, um, and they're talking about the recession here real quick. Let me.
Of BNY Mellon Wealth Management, Joe, of course, CNBC contributor. Tough day. I mean, the earnings not great, and the data's just bad. I mean, I don't know. We don't want to sugarcoat it. It's just bad data today.
It's recessionary. That's exactly what it is. Philly Fed is minus 31. The last times that Philly Fed was minus 31, 2020, 2008, 2001, 1991. I told you I was concerned.
All right. So this guy, Joe Terranova, I want to point this out. He makes a good point, and this is a good learning experience, children. Because what he's talking about, right, teaching moment. He's talking about leading indicators in the market, right, and leading economic indicators. So they're leading and lagging, right? So leading indicators are things that potentially could predict what's going to happen, right, or things that point to this is going to happen. And lagging are things that happen after the fact. So like unemployment would be like a lagging indicator because people lose their jobs after the recession starts. Right. But lagging are important because it's a good measure of how bad it was and did it really happen. Right. So you have to have the lagging indicators too. But he's talking about leading indicators. And right now, when he's talking about the Philly Fed, it's the Federal Reserve Bank of Philadelphia. Okay. Now there's the main Federal Reserve Bank in the United States, but there's a bunch of smaller ones throughout the country that have different regions that they do. But the Philly one is really a big one because it has, for finance people, it has two big things. One, it's a leading indicator for manufacturing. So if the Philly Fed is reporting bad results, negative results, then it means they're not expecting manufacturing to go up much. Right? The other thing about it is they do a report. I forget what it's officially called. It's a long title, but it's usually we just call it the anxious index, which talks about how anxious people are in the market or the economy actually is, right? And so
I've heard of that, but I kind of love that because like anxiety, that's real, man. And having some data on that.
Well, it doesn't hurt to look it up. They do one every quarter. But it gives you kind of a sense of what the market's doing, what the economy's kind of doing going forward. And it gives you that kind of a leading. So when he's talking about the Philly index, the last time they were kind of at this point were 220 during COVID, 2020, right? And then what else did he say? Was it I can't remember the exact dates. He did 2020, he did 2008. Right before the big housing crash, 2001, 91, all before big crashes. So the last of the Philly index was looking at this. There were recessions right after. So that's a leading indicator. And he's pointing out that, yeah, the last time they were kind of this bearish on things, and that was their report, it didn't lead to good things afterwards. So that's...
If we want to say that, the past is potentially going to predict the future, what we're looking at right now.
Well, we can never say the past predicts the future, but what we can say is in the past, this is what's happened. So there is...
Every time you've seen this other thing happens.
Right.
You might want to keep your eyes peeled.
So the probability is probably a little bit higher than we would like it to be on that front. But he's saying, there's... So this idea that, we know the Fed was trying to push us into a recession by raising interest rates. But he's telling you that, now we're seeing it. Right? So if you're somebody who plays stocks, these are the kinds of things you want to be paying attention to all the time.
For sure. I mean, nothing can tell you for certain what's going to happen. But, geez, when you see stuff like that, you go, well...
Yeah, maybe I should...
we have a pattern.
Maybe I should rethink. Well, he's going to go into some more leading indicators, too, I think.
All right,
about this week. The rhetoric that we heard from the Federal Reserve means they do not understand the environment that we're in right now. Auto loans, delinquencies are beginning to rise. What's the most important car payment that you have? It's your car payment. We saw it represented today in the statistics for housing. We see it universally. The economy right now, leading indicators, negative territory. The economy.
So he makes a good point there. So once again, leading indicators, but that's something to look at, right? People defaulting on their car payments or delinquencies on car payments. When he points that out, well, that's the most important payment. Most people are like, well, no, it's your house or blah, blah, blah. We can argue about that. But for this purpose, it's the most important because it's the one that you can't get to your job without a car for most people. So if you see car payments becoming delinquent or people defaulting, that's really dangerous because and people are more likely to delay paying their mortgage than their car because your car can easily be repossessed. It's a lot harder to repossess your house and it takes a lot longer. So you can get some more leeway on your home. Rent is a different issue, but car payments is a really big indicator. So because car payments also cover a lot of renters. So there's that. And he's saying we're starting to see it too with homes. So when you're starting to see this stuff, it's starting to look like, yeah, there's going to be a recession. There's going to be some pain. But once again, this is going to affect especially lower class people and their ability to survive. And then we're going to see unemployment then, like I said, a lagging indicator, rise once a recession hits. Because companies are going to want to do layoffs to cut their red ink, to slash their red ink in order to cover their costs. So he's made some good points just on simple leading indicators that, like, if you see that, red flag. Right.
As we sit here today, is probably in a recession. Is it statistically in a recession? Maybe it's not, but it sure feels like for consumers that that's exactly where we are. Look at the market. Where's oil? Oil is $1.50 above the level before the announcement of OPEC. That's on demand concerns. Look at gold. If we have a chart of gold this week, you'll see that you had a significant dip down to 1980. They came in, they bought it. Why? Because it's the disinflationary proxy, and the 2 years moving down again. We've got a problem economically.
Energy's weak.
Just real quick on oil and gold. Those are wealthy investors, especially if they have a lot of cash and they feel like there's going to be a recession and their cash is going to be worth less. Then what they tend to do is they tend to invest in things like gold, oil, treasury, inflation, protected securities, things like that. But the more you see those being bought, it means that wealthy investors are starting to panic about their cash reserves. And so they're trying to invest. So let's see what she has to say, because I think she says some smart stuff.
Tech is weak today. Discretionary is weak. What do we make of it?
So we're slow walking to the recession. It's not the boom that we thought it might be during the banking incident. I'm going to call it an incident and not a crisis, because so far it's not a crisis.
I agree.
But we're slow walking because of the contraction of credit. And the sectors that have got us to this point, with the S&P up 8% and NASDAQ up 16%, are really the sectors that are next up for some weakness here. Because ultimately, you cannot have a contraction of credit in small, medium-sized banks and not have it affect the real economy. Now, I still think the Fed hikes in May. It's all, the market's giving it to them at this point. It's 90%, 88% chance they're going to do it.
Not giving them anything more than that, though, right? If you look at the bond market.
Not giving them any more than that. But if there's a sort of linear progression downward in real activity, the Fed is not going to cut, because this is what they wanted, and they're going to get it.
Tesla's been
Now that's an interesting point.
Yeah, Duncan, can you break this down, what she's getting at a little bit more clearly for us?
Yeah, so she's talking about, what the market's doing, the parts of the market that are lagging. And they had it up on the screen there for a minute, discretionary and technology and some other stuff. They're the ones that you typically see go down first prior to a recession, because they're the ones that are a little bit more speculative for people. They tend to have, a little bit more volatility. The ones that have been sort of she doesn't foresee them doing well, is basically what she's saying, that they're weak right now because the Fed has raised interest rates. So what that does is it squeezes credit because now credit's become more expensive. Because once the Fed raises their interest rate, it goes down to the large banks and the medium banks, the small banks, and then your bank, right? And by the time it gets to you, that 0.25% raise that they made could be 4%, whatever it is, right? So people are borrowing less. Businesses are borrowing less, which means there's less people creating new business or new jobs. Right.
Right.
And that's what the Fed wanted to do. So it's going to squeeze that in the market. The next point she made, let me have her say it one more time, because it's the last point she made was interesting because she kind of gives her little theory about this. Let me just see. I can.
Linear progression downward in real activity, the Fed is not going to cut because this is what they wanted and they're going to get it.
Okay. So the Fed's idea, from her perspective, and she's probably right, I would agree with her on this, is the Fed thought, okay, we're going to raise the rates. This will squeeze inflation because that was their goal. So we're seeing a linear progression downwards in the market, right? It's not drastic. It's kind of predictable. And inflation's going down. And so whether that's because the Fed did this or it's just going down because things are leveling out is a
right,
different.
Because we suspected that maybe they've been taking a little unnecessary action because it was already going the right direction.
Yeah, most people think that's the point. Right. But as long as it's doing that, the Fed can justify that what it's doing is correct. And since that's what's happening at this moment, right, her prediction is, well, as long as it continues on that line, right, where the Fed feels comfortable with it, that it justifies their action, the Fed's going to continue to raise the rate. They're going to raise it again in May. They might raise it again later in the summer. So the Fed's going to feel justified in their action, regardless of the fact that it's created a recession. Because they're going to feel like we did actually do our job and squeeze inflation. Right? No, I mean, it's literally, the question is, I mean, are they just doing a rain dance and then, oh, now that it's sprinkling a little bit, right, it must be the rain dance.
It feels a little that way to me.
Right.
But, because you and I and a whole lot of other people already kind of felt like it was looking like it was already starting to go the right direction anyway. It feels like somebody tried to take an action unnecessarily just so they can claim credit for something.
Right. What it feels like is it started to sprinkle and then they started doing the rain dance and now they're taking credit for the rain. Right.
When it's raining a little bit harder, they were like, yeah, that was because we danced.
Right.
Not because it was already kind of raining and it got harder.
Yeah. And I'm sure that those two agree with us because the way they're talking about this is pretty sarcastically. Which is, the Fed's getting what they want, so they're going to keep pretending like they... But that's kind of what she said. And I think she knocked it out of the park. I think she could be wrong. I could be wrong. You could be wrong. But I think she knocked that one out of the park. I think she's probably going to be dead on right. But we'll see. We'll see. It'll be fun. It'll be fun to watch, boys and girls. Not really, because millions of people are going to be impoverished. But, it'll be what it's going to be. Anyway, let's go to